Hey everybody, welcome to Nursery Production and Management. Ollie wanted to say hi, so let me show you a picture of Ollie. So there he is, old sleepy Ollie. He's getting to be an old dog right now. Well, anyway, what we wanted to talk about today was revenue and expenses. The name of the course is Nursery Production and Management. And to understand some of the management aspects of the nursery industry, we have to understand a little bit about revenue and expenses, find out exactly what they are. So that is the topic for today. Let's see if I can get my PowerPoint going. Give me a second here. Hopefully you'll be able to see that. So revenue and expenses. Let's start out by defining what revenue is. Every business, whether it's a wholesale nursery or Apple Computer, has certain products or services that it's going to sell. So in the nursery business, a product that we may grow could include a Baldwin burlap or container grown tree. A service that we may provide, if somebody comes and mows your grass, that would be considered a service. If a garden center comes and installs a plant that you purchased at the garden center in your yard, then that would also be considered a service. So even the green industry, the industry that we work for, has certain services that we provide in addition to products. So the money that's owed to a business for the sale of its products and services is called revenue. And when a business receives payment from a client or customer for the products or services that the client has purchased, then the business will record those payments as revenue. Now, different businesses may choose to record revenue in different ways that are meaningful to the business. Let me give you some examples. Using a landscaping example, a landscaping company may choose to record revenue as follows. There may be revenue from the designs that they may sell their customers. There may be revenue from the installation of the plants into the landscape. There could be revenue from any hardscaping feature that the landscape design includes. Hardscaping would include things like patios, trellises, arbors, pergolas. Those types of things are referred to as hardscaping. And then maintenance. After the landscaping job is complete, many landscape companies will offer to maintain the landscape for the customer. And that maintenance may include pruning, trimming, removal of dead vegetation in the fall from herbaceous perennial plants, adding more mulch, fertilizing, and whatnot. Those would all be examples of maintenance activities. So when a company takes its revenue and divides it into subcategories, it has a better understanding of which parts of its business are doing better and which parts of its business are underperforming. Another example comes from a garden center. So a garden center could record its revenue as follows. They may have a separate category for Baldwin burlap trees, Baldwin burlap shrubs, container grown trees and shrubs, annual bedding plants and herbaceous perennial plants. Maybe they sell foliage plants, but not a lot. So they might put foliage plant sales under a category called other plant sales. And then finally, hard good sales. Hard good sales would include things like bagged mulch, stone, gravel, rock of different sizes, any pesticides or fertilizers that the garden center may sell, various other soil amendments, things like that would all fall under the auspices of hard goods. So we quickly looked at the revenue side of a business. Let's go ahead and take a look at the expense side of a business. Businesses have expenses just like you and me. For example, I have a truck payment that I have to make with GM Financial. I have utility bills that I have to pay for water, electricity, gas, and waste removal. And I'm sure that you have bills like that as well. Monies that a business owes to other parties are called expenses. And some examples of business expenses are these. Well, perhaps one of the biggest business expenses is the money that's owed to employees for the work they've done. Another business expense would include any money that's owed to vendors for supplies that a business needs to operate. For example, if you own a production nursery and you specialize in the production of container growing shrubs and trees, you would have to purchase in plastic containers, potting medium, liners, fertilizers, and these are things that you would purchase from vendors. They would be expenses to you. Another expense would be money that we owe to different governmental bodies for taxes and licenses. So just like we have to pay income taxes, businesses have to pay taxes as well. And then, of course, any money that a business owes to a bank for loans or mortgages would be other examples of business expenses. Now, we can take all business expenses and we can put them into two very large categories. One category is called variable expenses, and the second category is called fixed expenses. So let's see what the differences are. Variable expenses can go by another name. Some people refer to them as being cost of sales. And here's the important thing to remember. Variable expenses are job-related or production-related expenses. They will typically increase as sales increase. So the more units you make, the more sales you have, the greater your variable expenses are going to be. Here are some examples of variable expenses from the green industry. So any labor, and by labor, we're referring to hourly labor. So the labor that's used to complete a landscaping job, that would be a good example of a variable expense. It stands to reason if the landscaping job is a very large job, then it would take or require more labor to complete the job. A big landscaping job with a lot of plant installation is going to require more hours of labor to get all those plants installed on the job site. Another example would be concrete pavers that a landscaper would need to purchase in order to complete maybe a patio or something like that. That would be another example of a variable expense. The money that a garden center spends on purchasing plant material that it sells. The money that it spends on that plant material would be a variable expense, because in order to sell more plants at the garden center, it has to purchase more plants from a vendor. And then finally, the money a nursery spends on purchasing potting medium for container production is a great example of a variable expense, because each container that is lined out is going to require potting medium. And as the number of containers increases, the amount of potting medium also increases. Fixed expenses are different. They are also referred to as overhead expenses, or sometimes simply as overhead. Here's the important thing to remember about fixed expenses. They are not strictly job-related or production-related expenses. Generally, these expenses do not change much or at all with increasing sales. Let me give you some examples. The money that a company spends on advertising, I think a lot of people would agree, would be a fixed expense. Dues and subscriptions. Dues, what we're referring to here would be dues to professional organizations. If you're a landscaping company, perhaps you belong to the National Association of Landscape Professionals, and you would have to pay annual dues. Subscriptions refers to different journals or magazines that the company would purchase in order to keep abreast of the latest changes in the industry. Equipment repair and maintenance would also generally be considered a fixed expense. Now, something like equipment and maintenance, might have a variable component to it. You could look at it this way. You could think, well, the bigger the job, the more I have to use my equipment, and the more repairs and maintenance there's going to be on that equipment. So some of these fixed expenses do have a variable aspect to them, but generally something like equipment repair and maintenance would be considered a fixed expense by most companies. Insurance, licenses and permits to do business, office supplies, and salaries. So salaries are different from hourly wages. If somebody makes a salary, that is a fixed amount that they receive every month or every 2 weeks, regardless of what else is going on, or regardless of how many hours they put in, they still receive the same salary. So salaries, therefore, would be considered a fixed expense. Let's look at a hypothetical company called the XYZ Landscaping Company, and we'll see how they might organize what's called their chart of accounts. Every business is going to have a chart of accounts, and every business will assign a numerical code to each income, revenue, expense category that they have. And the chart of accounts will vary from organization to organization. So the XYZ Landscaping Company may choose to divide its revenue up into the following 4 categories, which we've already discussed. One category could be sales from designs, sales from the installation of plants, sales from maintenance contracts, and sales from hardscaping. On the expense side, we'll take a look at the variable expenses, also known as the cost of sales, that the XYZ Landscaping Company could have. They may have dump fees, and you may ask, well, what are dump fees? Many landscaping companies, when they arrive on a job site, they might have to remove some existing vegetation, maybe some trees and shrubs need to be grubbed out. There might be some poor soil and rock and other debris that has to be removed from the site. Okay, the landscaping company is going to have to dump these things at a landfill, and they will be charged to dump. So that's where dump fees come in. Equipment rental Well, it kind of makes sense. If the job is a big job, you're going to need more equipment rental. As the scale or scope of the job increases, then the amount that you spend on equipment rental will increase as well. Most landscaping companies don't necessarily own all the different pieces of equipment that they would need to do a job. So sometimes they rent equipment. Then there's hourly labor or hourly wages. So these would be the wages that would be paid to the employees that are doing the landscaping job, or in the case of a nursery business, the nursery laborers. Materials and supplies covers lots of different things. In our example of the wholesale nursery that specializes in container grown trees and shrubs, materials and supplies would include things like the container, the potting medium, fertilizer, the liner that you put into the container, and so on. Some companies, and again, I'm going to use an example from the landscaping business, use outside services or outside contractors. Maybe you have a very large landscaping job that requires the installation of a swimming pool. And as a landscaper, that's just not quite in your range of tools. Maybe you've never installed a swimming pool, you don't feel comfortable with that, so you hire a contractor to do that part of the job for you. So everything we just discussed would be examples of variable expenses. Let's go ahead and look at some examples of fixed expenses, also known as overhead. And there's quite a list, and there's another slide where the fixed expenses continue. I'm not going to go over each one of these. You can just kind of look the list over and see for yourself what they are. All right, so everything on these two slides that I just showed you would generally be considered fixed expenses by most companies. All right, so there's some terms that we need to be able to define, some numbers that we need to be able to work with if we're going to continue our understanding of basic business ideas. One concept is called gross income, which is also known as gross profit, and it's calculated as follows. Gross income is the total revenue minus variable expenses. Now remember, variable expenses are also known as cost of sales. So if you take total revenue and subtract your cost of sales, you end up with a number, a value that's referred to as the gross income. And in a little bit, we'll go through some numerical examples of these. Okay, the pre-tax income is calculated by subtracting overhead expenses from the gross income. So gross income minus overhead equals pre-tax income. Net income, also known as net profit, is calculated by subtracting the taxes that the company or business has to pay from pre-tax income. Here's an example. So let's imagine a company that has sales of $100,000. So that would also be revenue. Remember, I told you at the beginning of the presentation that for our purposes, sales and revenue are the same thing. So total revenue, total sales for this company is $500,000 per year. Now imagine that this hypothetical company has a cost of sales equal to $300,000. So in other words, in order to create that $500,000 worth of product, the company has to spend $300,000 in order to create the $500,000 in product. Overhead, which we defined as being those fixed expenses in this example, is equal to $150,000. So here's how we can calculate gross income. So gross income is going to be the total revenue, $500,000, minus the cost of sales, which is equal to $300,000. So when you take 500,000 minus 300,000, you get $200,000, and that is the gross income. So let's take it to the next step. If you want to determine what the pre-tax income is, then you would take the gross income, which is $100,000, and you will subtract the overhead expenses, which in our example are $150,000. So what you're left with then is $50,000. That is your pre-tax income. Now, assuming that federal and state taxes are 30% in this particular example, and that's probably in the ballpark. I consulted a friend who works or has worked for a business for many years, and he told me that roughly across the United States, the percentage of tax that corporations pay is somewhere between about 30 to 35% of their pre-tax income. So I picked 30% in this example. All right, so in order to calculate net income, we have to take the pre-tax income of $50,000 and we have to subtract the taxes. Well, the taxes are 30% of $50,000, which ends up being $15,000. So in our example, the net income would be $35,000. So in other words, the company is selling $500,000 worth of product. And at the end of the year, and we're assuming that this example is over the course of 1 year, at the end of the year, they have a net income of $35,000. And net income is famously known as the bottom line that you hear many people refer to when they're talking about different companies, different corporations. So $35,000 is all that they have in terms of income after selling $500,000 worth of product. Well, how can this happen? Well, it happens because of all the expenses that the company has. The variable expenses, which we call the cost of sales, and the fixed expenses, which we refer to as overhead. Okay, so a company can generate something called a profit and loss statement or an income statement. They are both the same thing. An income statement and a profit and loss statement are both the same, two different ways of saying the same thing. And what the income statement shows is the company's revenues and expenses during a particular period of time. So what is that period of time? Well, a company could generate an income statement every month or every quarter or semi-annually, which would be every 6 months. And then all companies would generate an income statement at the end of their business year. And income statements generally are provided to us in a standard format. So let me go ahead and show you an example of an income statement. Give me a second here to. All right, so here's an example of an income statement. I hope that you can see that. I'm going to try to use a marker to highlight some things here. Let's see if this works. So this company has total revenue of $500,000, which is right there. And their cost of goods sold, which represents all their variable expenses, is $150,000. So they can calculate their gross income or gross profit as being $500,000 minus $150,000 would equal the gross income of $350,000, which is right there. And then they have their overhead expenses, and that includes all these expenses that are shown here. Okay, those are all overhead expenses. So when you add all those up, they total $258,500. So in order to determine the net income before taxes, we're going to take our gross profit up here, also known as gross income, of $350,000, and we're going to subtract the overhead. So that'll be minus $258,500. And then we have a net income before taxes of $91,500. Okay, then we calculated the taxes as being $32,500. So if we subtract 32,500 from 91,500, then we have a net income equal to $59,000. So this is an example of an income statement. All right, let's go ahead and finish this off. So in conclusion, we said that different businesses may choose to record revenue in different ways that are meaningful to them. And businesses may not always agree on which expenses are variable or fixed. And another way to think about that is there are some fixed expenses that kind of have a variable component. So it's not always crystal clear as to whether they're variable expenses or fixed expenses. But with the help of an accountant, companies can figure these things out and move forward from there. Companies also have something called a chart of accounts that assigns a unique numerical code to each category of revenue and expenses. And the chart of accounts will vary from company to company. Once the chart of accounts is set up, then the company is obligated to stick with that format at least through one entire business year before they make any changes to it. I provided you formulas for calculating gross income, pre-tax income, and net income. And then we talked a little bit about an income or profit and loss statement, and I showed you how those are organized. So we took a look at that. Okay, so that is the end of this presentation. Let's see if I can get out of here. And stop sharing that. All right, I think you guys can see me now. So that was kind of a quick look at revenue and expenses for different companies. There will be another video for this week, and the video concerns a hot dog vendor in New York. And we're going to go through part of that video together. It's a video, and there's a worksheet that you're going to be kind of downloading, printing, and having with you as we go through the video. And then the very last page of that worksheet, you're going to turn back into me the next time we meet, because that page is worth 8 points. So we'll get to that in a little bit. Well, anyway, that's all I have for now until the next video. Thanks for watching.